Okay, hello everyone. So today we are going to discuss introduction to bookkeeping and accountancy, a very basic topic of accountancy, which many teachers and many students ignore it as it is a theoretical topic, and they feel the accountancy is a practical topic. But it is very much important for you to understand this introduction, the theoretical part of accountancy and bookkeeping. Uh, Even if you are in the 11th standard or the first year of professional courses like BMS, BBI, BAF, or you are preparing yourself for NET or SET examination. So before starting any topic, you must understand the basic concept or the term which it has origin. So in India, during the Chandragupta Maurya's regime, Mr. Kautilya wrote a book named Arthashastra, which means economics, wherein some reference can be traced regarding the ways of maintaining accounting records. Afterward, it was called as Deshi Nama. In the earlier times of civilization, accounting was done by the agents who managed the properties of wealthy people. They prepare accounts periodically for the owner's property. The records of debit and credit were found in 12th century itself. In 1494, an Italian merchant introduced double entry system of bookkeeping. Due to industrial revolution in 18th and 19th centuries, large scale operations were carried on and joint stock companies were emerged as important form of organization, which involves separations of ownerships from management. Hence, to safeguard the interest of owners and investors, the business establishments required detailed information about the business, which given a way for development of comprehensive financial accounting information system. So let's move to the meaning. In simple word, the bookkeeping means recording of the business transaction in the books of accounts in a systematic way. We'll move to the main objective. The main objective of the bookkeeping is to keep complete and accurate record of all the financial transactions in the systematic, orderly and logical manner. All the business transactions are to be recorded date-wise and account-wise. The bookkeeping serves as a permanent record of the mandatory transactions of enterprise business, and it can be produced as evidence whenever and wherever required. To know the profit or loss of the business during the financial year, to know the total assets and liabilities of the enterprise, to know what the businessman owes to others and what others owes to him. Businessman comes to know the current year's progress over previous years and compare its financial results with other business enterprises in similar line. If we talk about the importance, so the importance of bookkeeping follows a record, financial information, decision making, controlling evidence and tax liabilities. So accurate and timely bookkeeping is essential for financial transparency, compliance and legal requirements, and it supports effective business decisions. So let's move to the difference between bookkeeping and accountancy. Whereas bookkeeping is concerned with the recording and classifying the business transaction, the accountancy is related with the recording, classifying, summarizing, analyzing and interpreting the financial data. So we can conclude it as the bookkeeping is a subset of accountancy. Meaning and the definition of accountancy. Accountancy refers to the entire body of the theory and the process of accounting. Nearly every business enterprise has an accounting system. It is a means of collecting, summarizing, analyzing and reporting in monetary terms information about the business transactions. The basics of accounting. Very first is cash basis. The record only when the money changes the hands. The second one is accrual basis. record when the income is earned and expenses are incurred even if the money hasn't moved yet. Hybrid system, it's a combination of both cash and accrual basis used as per the requirement of the organization. Qualitative characteristics of accounting information. Very first, reliability. Accounting information must be accurate, verifiable, and faithfully represent economic events. Can we trust it? The question should be asked in every transaction while recording. Relevance. Does it help make decisions? Information must be influence decision making by having predictive or confirmatory value. Understandable. Is it easy to read or is it easy to understand? If yes, information should be clearly presented so that the users can easily comprehend it. Comparable. Can we compare it across the time or with others? Information should be consistent across periods and comparable with other entities. The very basic terminologies which we are using in accountancy is very first transactions. Basically, it's a business activity involving money, exchange of goods and services between two persons or parties for money or money's worth. It is known as transaction. Monetary transaction. The transaction which involves exchange of money or money's worth directly or indirectly, it is called as monetary transactions. Non-monetary transaction, the transaction which does not involve an exchange of money or monetary worth directly or indirectly are called as non-monetary transaction. Exchange of one things against another things, it is called as barter system or barter transaction. Capital and drawing. The total amount of invested in the business by the owner is known as capital. Capital can be introduced at the time of starting the business or in between whenever businessman feels they have to introduce some sort of money. Drawings, the amount of cash or value of goods or assets withdrawn from the business by the owner for the personal use is called as drawing. Debtors and creditors. Debtors is a person who has to pay to business for getting goods or services on credit basis. Creditors is a person whom business has to pay for getting goods or services on credit basis. Expenditures and types of expenditures. An amount spent by the business for any consideration received by the business is called as expenditure. Let's move to types of expenditure. So very first type is capital expenditure. This expenditure is incurred to acquire fixed assets or to increase the value of the fixed assets. It gives the benefits for the longer period of time and it is non-recurring in nature. Whereas revenue expenditure is expenditure from which no future benefit is expected but having immediate or short-term benefit, may be less than 1 year. It does not increase the profit earning capacity of the organization. These are normal day-to-day operating expenses of the business organization and appear in the debit side of trading and profit and loss account. It is recurring in nature. For example, salary, wages, rent, electricity bill, etc. Whereas deferred revenue expenditures are basically revenue in the nature but benefit of which is not exhausted within the 1 year. It is called as deferred revenue expenditure. Such expenditure is written off over a number of period of times. Such return off amount is shown on the debit side of profit and loss account and return amount is shown in the asset side of the balance sheet. For example, heavy expenditure on advertising, heavy legal expenses. The cash discount and trade discount. Basically, discount is a concession or allowance given by the seller to purchaser. If we talk about the cash discount, it is the amount deducted from the final amount due to the time of receipt. It is a concession given for encouraging prompt payment. It is given either for the spot payment or the payment within a specific period of time. Cash discount is calculated after deducting the trade discount. Since it is loss to the seller and gain to the buyer, cash discount appear in the books of accounts. Whereas trade discount, it is allowance given on the catalog price or list price of the goods. This discount is allowed at the time of purchase or sales of goods. Value of goods or purchase recorded in the net value payable after deducting the amount of trade discount allowed. If the goods is rupees 1000 are sold at 5% trade discount, the value of goods that will be recorded will be 950 both by the purchasers and as well as seller, not 1000. Hence, the trade discount does not appear in the books of accounts separately. Solvent and insolvent. If a person's assets are more than his liability or equal to his liabilities, it is called a solvent person. Solvent person is financially sound and in a position to pay off his debts, whereas insolvent person is one whose liabilities are more than his assets. Such person's liabilities are more, so by the time it is suggested to shut down the business. Accounting year, it is a period of 12 months for which the accounts are maintained and closed by the proprietors. It starts from 1st April and ends on 31st March every year. Trading concern and not for profit concern. A business concern established with the objective to earn profit by selling the goods is known as trading concern. It is also called as commercial organization or profit making organization, whereas organization which is not established for making profit but for rendering service to the society, it is known as not for profit concern. This type of organization may be formed for the promoting of useful objects like art, science, sports, culture, charity, profession, etc. For example, schools, hospitals, sports clubs, etc. are the examples of not-for-profit organization or not-for-profit concern. Whereas goodwill is the monetary term for the reputation of business. It is expressed in the terms of money. We consider goodwill as an intangible assets. Profit or loss. When the selling price of the goods is more than the cost price, it is known as profit. Profit increases the capital of the business, whereas when the cost price is more than the selling price, it is known as loss. Loss will decrease the capital of organization. Assets, liabilities, and net worth. Any physical things or right owned that has a monetary value is called as an asset. The ownership of assets must be with business unit, for example, land, goodwill, patent, computer, etc. If you talk about the types of assets, so we have three types of assets. Very first, fixed assets. The assets which gives long-term benefits to the business are known as fixed assets. For example, land, building, plant and machinery, goodwill, etc. These assets may be tangible or intangible in nature. Current assets, as assets which are held in the business for operating years and can be converted into cash very easily, are called as current assets. For example, debtors, bills receivable, cash in hand, stock, etc. The third type of assets is fictitious assets. These assets are not represented by tangible possession of property. They are imaginary assets but do not have any realizable value. For example, deferred revenue expenses like advertisement expense paid for 4 years, 5 years or 10 years. Let's move to the liability. Any amount payable by the business to the others is known as liabilities. It is a debt amount due from the business to others for the benefit received by the business unit. For example, loan taken, creditors, bank overdraft, outstanding expenses, etc. If you talk about the types of liabilities, so we have two types of liabilities. Very first, fixed liabilities or long-term liabilities, and the second one is current liabilities. The fixed liabilities or long-term liabilities is one major source of fund in the business. It may be in the form of capital, secured loan, long-term loans from bank or from any financial institutions, etc. Current liabilities is the short-term liabilities payable within a year. It is called as current liabilities. Current liabilities arise in the regular current operations of the business. These liabilities are not normally secured. For example, creditors, bills payable, etc. If you talk about the net worth of owner's equity or capital, The amount or fund provided by the proprietors in the business is called as capital, as well as the excess of assets over liabilities of the business is known as capital or net worth. Net worth includes capital as well as reserves and surplus. Now, the very important concept, accounting concepts, convention and principles. Basically, these principles are ignored by the many of the students by assuming that accounts is a practical subject, so we does not need to go in depth in theoretical part. But UGC-NET, the NTA knows very well that students are skipping these concepts and convention and principles, so they are asking question on this only. Very first, business entity. This concept implies that the business unit is separate and distinct from the owners or owners. That is the person who supply capital to it. Based on these concepts, accounts are prepared from the point of view of the business and not from the point of view of owners. Hence, business is liable to the owner for the capital contributed by him or her. Money measurement. This concept implies that only those transactions which can be expressed in the terms of money are recorded in the books of accounts. Since money serves as the medium of exchange, transactions expressed in the money are recorded, and the ruling currency of the country is the measuring units for accounting. The cost concept. An asset is recorded in the books on the basis of the historical cost, that is the acquisition cost. The cost of acquisition will be the base for all further accounting. It does not mean that the assets will always be shown at cost. It is recorded at the cost at the time of its purchase, but it is systematically reduced in its book value by charging depreciation. Consistency. Any policy adopted for the accounting should be continuous or consistent throughout the business, and it need not to be changed generally unless and until circumstances demand. However, it does not stop any improvement of new technique, but that should be disclosed with a note. Conservatism. While recording a business transaction, we have to anticipate no profit but provide all the possible losses. It encourages the certain secrets reserves by making excess provisions to prevent losses. The income statement may show lower income and the balance sheet overstate the liabilities and understate the assets. This policy of recording is asking account to play safe while writing the accounts. Going concern. It is a basic assumption that a business is going concern and will continue its operation for the future. Going concern concept influence accounting practices in relation to valuation of assets and liabilities, depreciation of fixed assets, treatment of outstanding and prepaid expenses, and accrued and unearned revenues. For example, assets are generally valued at historical cost. Any increase or decrease in the value of assets in the short term is ignored. Realization. Income is recorded only when it is realized. For example, either it is received or earned. Revenues are recorded only when sales are affected or the service are rendered. Sales revenues are considered as recognized when sales are affected during the accounting period, irrespective of the fact whether cash is received or not. Accrual concept. Income is recorded when it is accrued, that is earned, and expenses are recorded when it is accrued, being payable. All the expenses and revenues related to accounting period are to be considered irrespective of facts. The revenues are received in cash or not, or express are paid in cash or not. Dual aspects. According to these concepts, every transaction or event has two aspects, that is dual effect. For example, when a person starts a business with cash, on one hand the business gets cash and the other hand liabilities arise. That is, business has to pay that person a sum of rupees which is introduced by him as a capital. Disclosure. The accounts must be disclose all the material information. The accounting reports should disclose full and fair information to the related parties. The financial positions and performance should be disclosed very honestly to the users. The financial positions means the balance sheet of business, and the financial performance means business results in terms of profit or loss, and the income and expenses in profit and loss account. Materiality. According to this convention, financial statements should disclose all the material items which might influence the decisions of the users of financial statements. Hence, any item which is not significant and is not relevant to the users need not to be disclosed in financial statement. The matching concept. According to these concepts, revenue during the accounting period are matched with expenses incurred during that period to earn the revenue during that period. This concept is based on the accrual concept and periodicity concept. Periodicity concept fixes the time frame for measuring performance and determination of financial status. All the expenses paid during the period are not considered, but only the expenses related to the accounting period are considered. On the basis of this concept, adjustments are made for outstanding and prepaid expenses and accrued and unearned revenues. Also, due to provisions are made for depreciation and fixed assets, bad debts, etc. related to accounting period. Now, let's move to accounting standards, that is AS and IFRS. Accounting standards. It's a country-specific rules that guides financial reporting and consistency with the jurisdictions. For India, ICAI, that is Institute of Chartered Accountant of India, is setting accounting standards. IFRS, International Standards for Global Consistency. The full form of IFRS is International Financial Reporting Standards. Global standards aim at uniformity and transparency in financial reporting across countries. Why it is important? So these standards enhance comparability, reliability and accountability in the financial statement, crucial for stakeholders worldwide. Accounting standards issued by ICAI. Basically, I have grouped into 4 categories. Okay, the very first category is disclosure and valuation standards. These standards are concerned with how financial data should be presented or disclosed in the financial statement. AS1, disclosure of accounting policies. It requires businesses to disclose all the significant accounting policies like depreciation method, valuation of inventories, etc. used in the preparation of financial statements. AS2, that is valuation of inventories. It specifies that inventory should be valued at the lower cost or net realizable value. This ensures conservative accounting. AS3, cash flow statements. It's required and titles to present inflows and outflows of cash under operating, investing and financing activities. AS4, contingencies and events occurring after the balance sheet date, covers how to account for event that happens between the balance sheet date and the date of approval of financial statement. AS5, net profit or loss for the period, prior period items and changes in accounting policies, deals with the treatment of unusual and extraordinary items, prior period adjustments and consistency in accounting policies. Let's move to the second category. That is assets and contract standards. These standards deal with specific types of assets and long-term contracts. Very first, AS6, depreciation accounting. Now it has merged with AS10, was about systematic allocation of depreciable amount of an asset over its useful life. AS7, construction contract, deals with revenues and costs associated with long-term construction contract. Revenue is recognized based on the stages of completion. AS9, revenue recognition, explain when and how revenue should be recognized. For example, revenue from sales is recognized when risk and rewards are transferred to the buyer. AS10, property, plant and equipment. covers recognition, measurement, depreciation, and disposal of fixed assets. AS 26 Intangible Assets provides guidelines for identifying and valuing non-physical assets such as patent, copyrights, and goodwill. AS 28 Impairment of Assets require companies to ensure that their assets are not overstated. If the recoverable amount of assets is less than its carrying amount, it should be written down. Let's move to the third category, that is investment and transaction standards. This standards deals with specialized accounting treatments for foreign exchange, government grants, investments, lease, and other financial activities. Very first, AS 11. The effects of changes in foreign exchange rates cover how to account for the for the transactions in foreign currencies and how to translate financial statement of foreign operations. AS 12, Accounting for Government Grants, provides guidance on recognizing and presenting financial assistance received from the government, that is subsidies, incentives, etc. AS 13, Accounting for Investments, deal with classifications, current versus long-term valuation and reporting of investments in shares, bonds, etc. AS 14, Accounting for Amalgamation, prescribes accounting methods for merger and acquisition, either pooling of interest method or purchase method. AS 15, Employees Benefits, deals with the short-term and long-term employees benefits such as gratuity, pension, and leave encashment. AS 16, Borrowing Cost, specifies when borrowing cost like interest on loan can be capitalized, added to the cost of an asset instead of expense immediately. AS 19, Leases, distinguish between finance lease, transfer ownership risk, and operating leases, and explains their accounting treatment by both lessor and lessee. Reporting and disclosure standards. These standards ensure clarity, completeness, and transparency in how financial results and corporate relationships are presented. Very first, AS 17, Segment reporting, requires businesses to report financial information separately for different business segments or geographical areas. AS 18, Related party disclosure, mandates disclosure of transactions with related parties, for example, subsidiaries, key management personnel, to avoid conflict of interest or unethical dealings. AS 20, Earning per shares, EPS, guides how to calculate the and present EPS, a key indicator of company's profitability per shares of equity. AS 21, Consolidated financial statements, prescribe rules for preparing consolidated accounts when a company has subsidiaries. AS 22, Accounting for taxes on income, explains treatment of current tax and deferred tax arising due to timing differences. AS 23, Accounting for investment in associates in consolidated financial statements. It deals with how to account for investment in associated companies using the equity method. AS 24, Discontinuing operations, require disclosure and separate reporting of part of business that are planned for closure or sale. AS 25, Interim financial reporting, lays out the minimum content and principles for preparing quarterly or half-yearly financial report. AS 27, Financial reporting of interest in joint venture, covers the recognitions, measurement, and disclosure of company's interest in joint venture. AS 29, provisions, contingent liabilities, and contingent assets, provide rules for recognizing liabilities and potential assets that depend on uncertain future events. AS 30, 31, 32, Financial instruments, recognition, presentations, and disclosures. These three standards, eventually covered into IND AS, deals with the recognition, classification, measurement, and disclosure of financial instruments like loan, derivatives, etc. These standards help to ensure uniform presentation of financial data across the company's improvement, comparability, and compliance with national and global expectations. So let's move to Indian Accounting Standards (IND AS). These standards are mandatory for certain companies in India, especially large or listed ones. They are more comprehensive and aligned with the international norms than traditional accounting standards. Here are the IND AS or Indian Accounting Standard. IND AS 101, first time adoption of Indian accounting standards. It provides guidance for entities adopting IND AS for the first time. It helps in transitions from previous GAAP, that gap, to Indian AS, ensuring comparability. 102, share based payment prescribed accounting for employees shares options and other equity based payments, including valuation and recognition of the expense. 103, business combinations deals with merger and acquisition, require the use of purchase methods and fair value accounting for assets and liabilities acquired. 104, insurance contract provides temporary guidance on accounting for insurance contract until a more comprehensive IFRS standards IFRS 17 is adopted. 105, non-current assets held for sale and discontinued operations guides how to report assets that are intended to be sold and segments of business that are being discontinued. 106, exploration for and evaluation of mineral resources applies to entities involved in mining or oil exploration, deals with the cost and accounting during early stage exploration. 107, financial instruments disclosures specifies disclosures related to risk from financial instruments, for example, credit, liquidity, market risk, enhancing transparency. Indian Accounting Standards 108, operating segments. It requires reporting of business segments based on internal reports used by the management to assess performance. 109, financial instruments covers classification, measurements, impairment and hedge accounting of financial instruments like loan, investment, derivatives, etc. 110, consolidated financial statements specifies how a parent company should present financial statement by consolidating its subsidiaries. Focuses on control as the basis for consolidations, require a single set of financials for the group as if it were one entity. 111, joint arrangements defines accounting for joint operations and joint ventures. Classification is based on rights and obligations rather than legal structure. Uses equity methods or proportionate consolidation based on the arrangement. 112, disclosure of interest in other entities requires detailed disclosures about interest in subsidiaries, joint arrangements, associates, unconsolidated structured entities, provides insights into the risk and financial effects of these interests. 113, fair value measurement establishes a single framework for measuring fair value and requires use of market-based measurement, not entity-specific. A three-level hierarchy of input used to determine fair value. The level 1, quoted price; level 2, observable data; level 3, unobservable data. 114, regulatory deferral accounts allow companies to continue certain accounting practice for regulatory deferral account during the transitions to Indian AS, primarily used by entities in regulated industries like utilities. 115, revenue from contracts with customers, a comprehensive standards that replaces older revenue standards, recognizes revenue when control of goods or services is transferred, follows a 5-step model, Step number 1, identify contract. Step number 2, identify performance obligation. Step number 3, determine transactions price. Step number 4, allocate price to obligations. Step number 5, recognize revenue when performance obligations is satisfied. 116, leases replaces IND AS 17. Lessee must recognize most lease on the balance sheet as the right of use assets and a lease liability. Aims to improve transparency by eliminating off-balance sheet leasing. 17. Leases superseded but still referenced. These older standards differentiated between financial lease recognized on balance sheet and operating lease off balance sheet, and the AS 116 has replaced it. It may still be referenced for historical data or transition. 18. Revenue superseded by IND AS 115 but is still referenced. These standards cover revenue recognition for sale of goods, rendering of service, interest, royalties, and dividends. It is replaced by IND AS 115 but may be mentioned in the earlier reports on or in specific context. IND AS 18, revenue, again it is superseded by IND AS 115 but still it is referenced. Previously provided rules for recognition revenue from sale of goods, rendering of service, use of enterprise resources like interest, royalties, dividend, now largely replaced by IND AS 115, which offers a more unified approach. 19. Employees benefits deals with all forms of employees compensation, short term benefits like wages, bonuses, paid leave, etc., post employment benefits like pensions, gratuity, etc., other long term benefits like long service leaves, etc. This requires actuarial valuations and present value techniques for defined benefit plan. 20. Accounting for government grants and disclosure of government assistance. This provides guidance for recognizing government grants, capital or revenue nature, reflecting grants in income when conditions are fulfilled, disclosing any form of government assistance even if no value is directly measurable. 21. The effect of changes in foreign exchange rates. It applies to companies with foreign currency transactions, foreign operations like subsidiaries or branches abroad. The key aspects of these standards is use of functional currency, translation of transactions and balances, reporting effects of exchange rates changes. 23. Borrowing cost requires capitalization of borrowing costs that are directly attributable to acquisition, construction, or production of qualifying assets, for example, building, machinery, etc. Other borrowing costs are expense in the period incurred. IND AS 24, related party disclosures, ensure transparency by requiring disclosure of relationship and transactions with the related parties, for example subsidiaries, key management personnel, etc. Details like nature, amount and the term of such transactions. Accounting and reporting by retirement benefit plans applies to retirement funds, for example pension fund. It required them to prepare separate financial statements, emphasizing disclosure of plans, obligations, assets, and performance. 27. Separate financial statements applies when an entity chooses to present separate financials, not consolidated. Covers accounting for investment in subsidiaries, joint ventures, and associates in such statement. IND AS 28, investments in associates and joint venture, prescribes the use of equity method to account for investments in associates, significant influence, joint ventures, shared control. 29. Financial reporting in hyperinflationary economies, applicable when an economy is experiencing hyperinflation, that is very high and typically accelerating inflation. Financial statement must be adjusted for price level changes to present a fair view. Assets, liabilities, income and expenses are restated in terms of measuring unit current at the end of reporting period. 32. Financial state instruments presentation deals with the presentation of financial instruments like loan, shares, bonds, etc. as either liability or equity. Focuses on classification of financial instruments, distinctions between debt and equity, offsetting of financial assets and liabilities in the balance sheet. 33. Earning per shares, that is EPS, prescribe how to calculate and present the basic and diluted EPS, a key metric for investors, required for companies whose shares are publicly traded, ensure consistency and comparability of EPS data. 34. Interim financial reporting provides minimum requirement for preparing quarterly or half-yearly financial reports, helps in timely and reliable updates on financial performance during the financial year. 36. Impairment of assets requires companies to ensure that their assets are not overvalued. If the recoverable amount, that is higher value in use of fair value, less cost to sell, is less than the carrying amount, the assets is impaired and must be written down. Provision, contingent liabilities and contingent assets provides rules for recognizing provisions, that is present obligation from past event, disclosing contingent liabilities, possible obligations, reporting contingent assets, possible assets not yet certain. 38. Intangible assets covers the recognition, measurement and amortizations of intangible assets like patent, trademark, copyright, software, etc. Assets must be identifiable, controlled by the entity and provide future economic benefit. 40. Investment property defines and regulates properties held to earn rent or for capital appreciation, not for use of sale in the ordinary course. Measured used cost model, but fair value must be disclosed. Last, IND AS 41 agriculture applies to accounting for biological assets like livestock, crops, etc. and the agriculture produce at the point of harvest. Measured a fair value less estimated cost to sell. This IND AS ensures that India's financial reporting standards are aligned with the global IFRS, promoting greater investors' confidence and comparability. Now, this slide presents a group-wise classification of various IND AS that is already discussed in the earlier slides. IND AS 101 to 116 core standards. This covers comprehensive range of topics including first time adoption, that is IND AS 101, revenue recognition 115, lease rates 116, business combinations, financial instruments, employees benefits, etc. These are the main functional standards used regularly in the preparation and presentation of financial statements. 110 to 114 consolidated and fair value. This group focuses on consolidated financial statements, joint arrangement, disclosures of interest in other entities, fair value measurements, regulatory deferral accounts. This standard supports group reporting and valuation accuracy. 120 accounting for service concession arrangement, not always included but recognized. This is an additional standard, not part of the core for 241 list. Applies specifically to public-private partnership (PPPs), such as infrastructure projects where private companies operate public assets. It provides rule for recognizing revenues, assets, and liabilities in such service concession arrangement. While IND AS 120 is not always listed in the official set, it is recognized for practical use when applicable, particularly in infrastructure and utility sector. So this slide serves as a consolidated overview to help learner see how the numerous IND AS fits together, whether by topic or application area. Thank you so much for watching this session on bookkeeping and accountancy, especially if you are preparing for exams like UGC-NET in commerce. I truly hope today's content helped clarify some key aspects and made your learning journey a little easier. If you found this video helpful, please take a moment to hit a like button. It encourages me to keep creating more focused and student friendly content just for you. And yes, don't forget to subscribe to the channel and press the bell icon so you stay updated with all the upcoming videos, whether it's theoretical explanation, revision tricks, or MCQs practice for UGC-NET or other commerce exam. Also, please do share this video with your friends or classmates who are preparing for the same subject. Let's grow together. Lastly, if you have any doubts, questions, or need further classification, just drop a comment below. I personally go through your comments and try to respond to each one. Thank you once again for your support. Keep learning, stay consistent, and I will see you in the next video. All the best to everyone.